47.6 million ounces. That's how much silver was claimed for physical delivery from COMEX warehouses in just 4 trading days this December. Not over a week, not over a month, 4 days. And it represented 60% of the entire registered silver inventory available for delivery on the world's largest silver futures exchange. The official explanation from CME Group: normal market activity, routine deliveries, nothing unusual. But here's what they didn't mention in their public statements. This was the largest vault drain in COMEX history, not just in dollar terms, in actual physical metal claimed. And it happened during the same week that discount window borrowing at Federal Reserve banks spiked to levels not seen outside of acute banking crises. The timing wasn't coincidental. 3 days before the silver vault drain began, the Federal Reserve quietly expanded access to its emergency lending facilities. The discount rate remained at the top of the federal funds range, but the operational framework changed. Banks that had avoided the discount window for years due to stigma suddenly began tapping it at rates approaching early pandemic levels. But that wasn't the strangest part. On January 1, 2026, China implemented export restrictions on refined silver that effectively lock up 65% of global refined silver supply. The announcement came on December 27th. Markets had 6 days' notice. And in those 6 days, COMEX registered silver inventory fell by an additional 8.1 million ounces as JPMorgan delivered 99% of January contracts to waiting buyers. Connect these 3 events: Fed emergency lending expansion, historic COMEX vault drain, China export controls. This isn't normal market functioning. This is a system under pressure. And the data points to something most market participants don't yet understand. The price discovery mechanism for silver is breaking down. But to understand why that matters, you need to understand what happened in late 2025. For decades, the COMEX silver market operated on a simple premise. Futures contracts represented claims on physical silver stored in approved warehouses. Those contracts traded based on expectations of future supply and demand. The spot price reflected immediate availability. Futures prices reflected expectations of availability at contract expiration dates. This relationship, called contango, is considered normal. Futures trade at a premium to spot because storing physical metal has costs. But in October 2025, something changed. Silver futures contracts began trading at a discount to spot prices. The spread wasn't small. On multiple trading days in November, the spot price exceeded the February future by 60 cents per ounce. By December, that spread had widened to over $1 per ounce on an intraday basis. This condition, called backwardation, signals one of 2 things. Either the market expects future silver to be more plentiful than current silver, which makes no sense given declining mine supply, or current physical silver is scarce enough that buyers will pay a premium for immediate delivery. The data confirms it's the latter. COMEX eligible inventory reached a record high of 342 million ounces on October 3, 2025. But eligible inventory doesn't mean available for delivery. It means the silver meets COMEX standards, but hasn't been designated for futures contract settlement. The critical number is registered inventory, the silver actually available when futures contracts demand physical delivery. That number tells a different story. Registered COMEX silver inventory peaked at 243 million ounces in April 2020. By December 2025, it had fallen to 127 million ounces, a decline of 73%. But the open interest in silver futures, the number of contracts outstanding, remained near all-time highs. In November, open interest exceeded 600,000 contracts. Each contract represents 5,000 ounces of silver. That's 3 billion ounces of paper claims, against 127 million ounces of registered physical silver available for delivery. The math doesn't work unless the assumption is that nearly every futures contract will be closed with cash settlement instead of physical delivery. That assumption held for years. It doesn't hold anymore. December's vault drain proved it. When 60% of registered inventory was claimed in 4 days, it exposed what analysts like Andrew Maguire have been warning about for years. The London and New York precious metals markets have been operating on the assumption that physical delivery requests would remain minimal, that most participants trade futures for price exposure, not to acquire actual metal. But something changed in 2025. Industrial buyers started standing for delivery, not speculators, not retail stackers trying to squeeze shorts. Industrial users who need physical silver for manufacturing, companies in the solar panel industry, electric vehicle manufacturers, electronics producers, entities that traditionally bought silver through direct dealer arrangements or regional exchanges. They started using COMEX futures as a physical acquisition channel. Why the shift? 3 factors converged. First, regional premiums exploded. In Shanghai, physical silver traded at premiums exceeding $8 per ounce over COMEX futures prices by late December. In Tokyo, premiums hit similar levels. When Shanghai physical costs $80 per ounce and COMEX futures settle at $72, industrial buyers have a massive incentive to take COMEX delivery and export the metal. The trade becomes a guaranteed profit even after considering logistics and financing costs. Second, Shanghai silver inventories collapsed. The Shanghai Gold Exchange held over 700 tons of silver in early 2025. By December, that figure had fallen below 446 tons, the lowest level since 2016. More than 300 tons left the Shanghai vaults in October alone. That silver went somewhere. Export data suggests much of it flowed to industrial users in Southeast Asia and South Asia, where electronics manufacturing concentrates. Third, lease rates spiked. The 1-month silver lease rate, the cost to borrow physical silver for 30 days, normally runs between 0.3 and 0.5%. In November 2025, it exceeded 7%. That rate implies physical silver scarcity. When holders of physical metal can earn 7% lending it for a month, they will. When borrowers are willing to pay 7% for a month of silver access, they need it desperately. This only happens when spot availability is genuinely tight. The lease rate has since fallen to around 4.5%, still 9 times the historical norm, still indicating physical stress, and that brings us to the Federal Reserve's emergency lending operations. On December 15, 2025, several regional Federal Reserve banks reported unusual spikes in primary credit borrowing through the discount window. The specific institutions weren't disclosed. Federal Reserve disclosure rules require a 2-year lag before borrower identities become public. But the aggregate data showed discount window utilization rising to levels last seen during the March 2023 regional banking crisis. Why does discount window borrowing matter for precious metals markets? Because it indicates stress in the banking system's liquidity plumbing. Banks don't tap the discount window unless they face funding pressures they can't resolve through normal interbank channels. The stigma attached to discount window borrowing is so severe that most banks will pay premium rates to borrow from the federal home loan banks before approaching the Fed. But FHLB rates moved higher in late 2025. FHLB advances, traditionally cheaper than discount window borrowing, began pricing at spreads that made the Fed's primary credit rate competitive. For smaller banks facing end-of-year balance sheet pressures, the discount window became the least bad option. This matters because banks are the intermediaries for precious metals trading. JPMorgan holds the largest precious metals vault in New York. HSBC and Standard Chartered dominate London precious metals clearing. When these institutions face liquidity pressure, their ability to facilitate metal movements constrained. They become more selective about which clients they extend credit lines to. They demand more collateral. They charge higher fees for vault services. This creates a doom loop in physical markets. Tight bank liquidity leads to higher costs for physical metal transactions. Higher transaction costs push industrial buyers toward futures markets for physical acquisition. Increased physical delivery pressure drains vault inventories. Lower inventories increase backwardation. Backwardation incentivizes more physical claims. The cycle reinforces itself. The December vault drain accelerated this cycle, but it also triggered a response from CME Group. On December 23rd, CME issued Advisory 25-393, effective January 2nd, 2026. Silver futures margin requirements increased from approximately $9,000 per contract to $25,000 per contract, an increase of 178%. The official rationale? Increased price volatility and risk management prudence. The actual reason? CME needed to slow the pace of physical delivery requests before registered inventory reached critical lows. Tripling margin requirements doesn't stop determined industrial buyers, but it does force smaller speculators and retail participants out of the market. It reduces open interest. Lower open interest means fewer potential delivery demands. The move worked temporarily. Silver prices pulled back from the $84 peak, reached on January 7th to around $76 as of this recording. Open interest in near-month contracts declined as traders rolled positions forward or closed them entirely. The immediate delivery pressure eased. But the underlying problem didn't go away, because on January 1st, China's export restrictions took effect. China controls 65% of global refined silver production, not 65% of Chinese silver production for export. 65% of all refined silver produced globally passes through Chinese refineries at some point in the supply chain. The new restrictions don't ban exports entirely, they require export licenses. Those licenses will be granted according to Chinese government statements, based on domestic industrial needs and strategic considerations. What does that mean in practice? It means Chinese authorities now have discretion over refined silver flows. During periods of high domestic demand, exports can be throttled. During periods of geopolitical tension, exports to specific countries can be restricted. The refined silver market just became a strategic commodity controlled by a single nation. This changes everything, because refined silver isn't just used in solar panels and electronics. It's used in medical imaging equipment, defense systems, water purification, nuclear reactor components. Losing access to 65% of global refined silver supply would cripple industries across multiple sectors. Western governments understand this, which explains what happened in the first week of January 2026. According to trade data released by CBP, imports of refined silver into the United States surged to the highest weekly level on record in the final week of December 2025. Shipments categorized as strategic industrial materials exceeded normal volumes by a factor of 4. The timing isn't subtle. Companies and possibly government agencies rushed to import silver before the Chinese restrictions took full effect. This explains the continued delivery pressure at COMEX. On January 7th, 1,624 silver contracts stood for delivery. JPMorgan delivered 99% of that metal. 8.1 million ounces transferred from registered inventory. But here's the twist. COMEX open interest increased that same day. January contracts rose by 1,431. February contracts rose by 1,564. Buyers are using COMEX futures as a physical delivery vehicle faster than sellers are willing to provide metal. This should drive futures prices higher relative to spot. It's doing the opposite. Spot silver is trading at premiums to futures. The backwardation persists. Why? Because futures sellers can't deliver metal they don't have. So they're offering discounts to spot to entice contract holders to take cash settlement instead of physical delivery. Some industrial buyers are accepting, many are not. This creates an impossible situation for short position holders. Traditional commodities market dynamics assume shorts can always deliver. Wheat futures shorts can deliver wheat. Oil futures shorts can deliver oil. They may take losses on the transaction, but physical delivery is always possible. But COMEX silver shorts are discovering they can't always source metal for delivery. London vaults, the traditional backstop for COMEX supply issues, are facing their own strain. LBMA vault holdings remain opaque, but lease rate data suggests London is tight. When London can't provide reliable backstop supply, COMEX shorts face a structural problem. They either need to buy back their positions at market prices, which drives futures higher, or they need to push for cash settlement by offering discounts to spot. The first option causes short covering rallies. The second causes backwardation. Both are happening simultaneously in different contract months. The result is unprecedented volatility. Silver traded in a $9 range on January 8th alone, from $73.85 to $79.02, a 12% intraday range on a commodity with decades of price history. This isn't normal. This is price discovery failing. And that's why the Federal Reserve's emergency lending matters more than most people realize. Because the banks that facilitate precious metals trading are the same banks that need emergency Fed support when liquidity dries up. If those banks curtail their precious metals operations due to balance sheet concerns, the physical delivery infrastructure breaks down further. We've seen this before. In September 2011, MF Global collapsed. The firm was a major commodities broker. When it failed, thousands of clients lost access to their positions overnight. Physical delivery channels seized up for days. Prices disconnected from fundamentals as markets dealt with the operational chaos. The current situation isn't as acute as MF Global, not yet. But it shares structural similarities. Too many paper claims on too little physical metal. Banks facing their own liquidity challenges, geopolitical forces constraining supply chains, margin requirements ratcheting higher to slow delivery demands. Andrew Maguire, who has traded precious metals for 40 years, called this outcome in multiple interviews throughout 2025. He argued that once physical delivery pressure exceeded a certain threshold, the paper futures market would break down, not through default, through a gradual erosion of the futures-spot relationship until futures prices became meaningless for determining physical metal availability. That's exactly what's happening. You can see it in the data. The CME's own warehouse stocks report, published daily, shows registered silver inventory falling while eligible inventory rises. This means silver sitting in COMEX warehouses is being reclassified as not available for delivery, even as total warehouse stocks increase. Owners are withdrawing their willingness to deliver against futures contracts while keeping metal in the COMEX system. They're saying the price isn't high enough to incentivize sale. This is the definition of a shortage, not a shortage of silver globally. A shortage of silver at current prices willing to settle futures contracts. That gap between available supply and demand at the current price level will close. It always does. The question is whether it closes through price rising to clear the market or through futures markets abandoning physical settlement. If COMEX moves to cash-only settlement for silver futures, which some analysts now consider possible, it would mark the end of nearly 60 years of continuous physical delivery at the world's largest silver exchange. The implications would extend far beyond silver markets. It would signal that paper derivative markets can no longer be relied upon to provide access to physical commodities. That would force industrial users to build larger strategic inventories. It would incentivize hoarding. It would make supply chains more fragile. Gold is watching closely. The gold market is larger, more liquid, more institutionalized. But it faces similar dynamics. Central banks added 1,037 tons of gold to reserves in 2025, a record. Much of that gold never traded through COMEX or LBMA. It moved directly from refineries to central bank vaults through bilateral arrangements. This sidesteps price discovery mechanisms entirely. The traditional gold and silver trading system assumed that most participants were financial entities seeking price exposure. A few industrial users, some jewelry demand, central banks as marginal players. That assumption no longer holds. Central banks are the largest buyers. Industrial demand for silver is at all-time highs, and financial entities that traditionally held paper claims are increasingly demanding physical settlement. This shift forces a reckoning. Either precious metals prices rise enough to clear physical markets, or the paper futures system admits it can't deliver and moves to cash settlement. Either outcome represents a structural break from the last 50 years. So where does this go from here? The Federal Reserve's emergency lending will continue as long as banks need it, which they will, because global dollar liquidity remains tight. Quantitative tightening officially ended, but the Fed's balance sheet is still declining through natural runoff of maturing securities. Bank reserves remain near the lower end of what's considered adequate. In this environment, banks will prioritize core operations over facilitating commodities trades. Precious metals trading, while profitable in normal times, becomes a liability when market stress amplifies operational risks. So banks will tighten lending standards for metals trades. They'll require more collateral. They'll reduce position limits. This will further constrain physical delivery channels. Meanwhile, industrial demand for silver continues growing. Solar panel production is expanding globally. Electric vehicle sales are increasing. AI data centers require massive amounts of silver in their cooling systems and circuit boards. None of this demand is going away. If anything, it's accelerating. The supply response is inadequate. Primary silver mine production is essentially flat, has been for years. Most silver comes as a byproduct of copper, zinc, and lead mining. Those operations don't increase production just because silver prices rise. They're optimized for their primary metals. Secondary silver supply, recycling, is also constrained. Industrial silver use in electronics and solar panels means the metal is dispersed in products with long, useful lives. It won't be available for recycling for decades. Jewelry and investment silver can be recycled when prices rise high enough. But that supply is measured in thousands of tons annually. Industrial demand is measured in tens of thousands of tons. The math says silver prices need to rise significantly to balance the market. But price can't rise if futures markets won't allow it to, and futures markets can't allow it to if physical shortages force cash settlement. This is the paradox facing silver right now. Smart money is watching what happens in the next delivery period. If March COMEX deliveries proceed without incident, if registered inventory rebuilds, if backwardation fades, then the December event was a temporary dislocation. The system survived. Prices stabilize. Business continues. But if March sees similar delivery pressure, if registered inventory continues falling, if more regional premiums blow out, then we're in the early stages of a structural shortage that won't resolve at current price levels. In that scenario, silver prices will need to rise until demand destruction occurs. That could mean $100 per ounce. It could mean $150. No one knows where the clearing price sits. What we do know is that the Federal Reserve's emergency lending, the COMEX vault drain, and China's export restrictions are all symptoms of the same underlying condition. The post-pandemic world broke more supply chains than have been repaired. The financial system that worked when globalization was expanding doesn't work the same when supply chains fragment and geopolitical blocs form. Silver is canary in the coal mine. It's a small enough market that stress shows up quickly. The gold market is larger and moves more slowly. The copper market is even larger and has more diverse supply sources. But they all face versions of the same dynamic: growing physical demand, constrained supply, paper market struggling to reflect physical reality. This isn't 2011. The system isn't going to collapse overnight, but it is changing. The COMEX vault drain in December 2025 will be remembered as one of the moments when that change became undeniable. When the gap between paper claims and physical reality became too large to ignore. For anyone holding physical silver, the message is clear. Don't sell into paper price weakness. The physical premium is what matters. If spot silver is $76, but physical coins trade at $85, the real price is $85. The futures market is lying about availability. For anyone considering positions, understand that this is no longer about speculating on price. This is about gaining exposure to an asset whose official price discovery mechanism is breaking down. That creates opportunity. It also creates risk. Because when price discovery breaks, volatility becomes extreme and unpredictable. The Federal Reserve knows this. That's why emergency lending facilities are quietly being expanded, not to save silver markets, to prevent a broader commodity market dislocation from spreading to bank balance sheets. Because if enough banks are caught wrong-sided on precious metals positions, when physical delivery demands surge, it becomes a banking problem. And if it's a banking problem, it becomes a systemic problem, which means it becomes a Federal Reserve problem. So, we watch. We watch the H4 Premium Statistical release for discount window borrowing. We watch COMEX warehouse stocks for registered inventory changes. We watch Shanghai Gold Exchange data for physical flows. We watch lease rates for signs of physical tightness. The data will tell us if December was an anomaly or the beginning of something larger. Right now, 3 weeks into 2026, the data suggests it's not over. Registered inventory hasn't rebuilt. Backwardation persists. Industrial buyers continue taking delivery. China's export restrictions are just beginning to impact flows. This is what the beginning of a physical shortage looks like. Not chaos, not panic, just steady, relentless pressure as the gap between paper claims and physical availability widens. Until something breaks. Either the price rises enough to clear the market, or the market admits it can't clear and moves to cash settlement. Either way, the silver market that existed in 2024 isn't coming back. The COMEX vault drain of December 2025 made sure of that. What comes next will depend on how long market participants believe futures contracts represent claims on real metal. Right now, in January 2026, that belief is being tested. And the test isn't over.